While we will be discussing your optimal strategy to reduce your personal taxes, we'll also look at what will be the impact on your company. One question that we often get asked by our clients is, how should they pay themselves through their limited company and how should they be tax efficient? So today in this company, we'll discuss if you are running your own limited company and how you should pay yourself and make a difference to your tax bill. Let's break it down. But I'm Rashid from R&R Accountants. In this video, we will discuss how as a company director, you should pay yourself a combination of salary and dividends. Now let's look at some options. As a company director, you can take salary. This salary will count as an expense for your company. That means your company will save 20% tax on whatever salary you are drawing. So keep yourself to a threshold where you end up paying minimum or no tax or national insurance. Call it's 12,500 and you get taxed through your PAYE. On top of it, you can also pay yourself a dividend. Now, dividend when you receive is taxed at a basic rate of 8.75. If you're on higher rate, then it's 33.75% or additional rate is 39.35. Tax-free allowance for dividend is 500. Please remember, for year 2025, your dividend allowance or tax-free allowance is £500. Previously, it was 1,000 or 2,000 or more than that. What should be your strategy? A typical strategy is you take salary and keep your salary to personal allowance and a threshold. Also take dividends and combination of that will become your personal income. Please don't forget, your company will need to show profits before you can legally take any dividends. Any dividends that you draw for your company, you will have to file your personal tax returns and disclose dividend income to HMRC. Now at our accountants, we help directors plan their income and reduce their overall tax bill that is allowed. If you want a director pay plan, get in touch with us. We can discuss what will be the options available. Now we have just discussed that you can draw salary and dividend from your company. Now this part was just dealing with your finances, your personal income. Let's look at what will be the impact on your company. Now remember, we just discussed that your company has to make profit to pay you dividend. So let's suppose if you are a small company, your company is making profit. First, company will pay 20% tax on that profit. First, your company will pay taxes on the profits. Then the profit after tax that is left, you can take it as dividend, depending you're taking 500 or 5,000, and accordingly in your personal tax return you will pay tax at 8.75% or higher rates if applicable. Please remember, your company will have to pay taxes on its profit before you can draw dividends. So most of the times people do not look at this point that company will also be paying taxes. So this becomes part of your company cash flow, and most people forget the part where their company taxes are calculated. Please remember, it will be company tax, tax on dividend and your salary, and you have to file your personal tax return and combined income. If that exceeds certain thresholds, you may end up paying higher rate of tax. If you need any additional help or information, you can always contact us on the numbers given below. Thank you.